Hello, everybody, and welcome. As you're all joining, I can see our attendee numbers jumping up. This is Andy Last. I'm the media manager at Pure Financial Advisors. Thank you all for joining us for this Q2 market update webinar. We'll get started in just a few seconds here while everybody joins into the room. Of course, Brian Perry, our Executive Vice President and Director of Research, will be your presenter today. Hello, Brian. How are you today?
Doing awesome. How about you?
I'm doing well. As a reminder, if you have any questions through the course of this presentation, there's a Q&A button down at the bottom of Zoom. Just type your questions in there and Brian will answer them at the end. We're planning on going for, what did you say, 30 minutes?
Yeah, 30. Yeah, no more than 45 minutes. We want to keep this. There's a lot of material here. We want to keep it at a level people don't nod off on.
Right. So if it gets long, let us know.
Yeah, please just, type in there, say Brian is really long-winded, and I'll speed it up a little bit.
All right. So I think we've got just about as many people as we are going to get. So please welcome Brian Perry, CFP and CFA. Brian, thank you for joining us today.
Cool. Thanks, Andy. Thanks. Yeah, so welcome, everybody. We wanted to do, we've been doing periodic, first weekly and then monthly updates here on the economy and the markets. Sometimes just me, sometimes Joe and I together. Just wanting to keep everybody in the loop as far as what's going on. We've certainly had an interesting start to the year, to say the least. And I think that, first and foremost, hopefully everybody out there is healthy and your families are healthy and safe. Looking forward to, at some point in the future, seeing you all in person again. But for the moment, we just want to keep you informed and let you know what's going on in the markets and portfolios and the like. We were doing these weekly during the height of the crisis back earlier in the spring. Fortunately, I think things have settled down a little bit, and so we've gone to more of a monthly basis here. And what I wanted to do this time is kind of just give you an update on performance, the markets, that kind of thing over Q2. And, just to set the stage here, first of all, if you have questions, like Andy said, go ahead and ask, and we'll get to as many questions as we can. That's me. But let's do this. Let's dive into a market overview. And just to set the stage, where we were last quarter, heading into it, if you remember back to the dark days of March, was the sharpest sell-off we've seen in stock markets virtually forever, and probably what was the sharpest decline in economic activity on record. By a lot of accounts, this is now a recession and is the sharpest decline in economic output in certainly living memory, and may also be the most rapid rebound too. I'm not sure that I buy into some of those thoughts about a V-shaped recovery and that everything is suddenly all right. But certainly by almost any measure, economic activity has picked up. And here, as I dive into these numbers, you see a lot of green arrows last quarter with US stocks up 22%, international developed up 15, emerging markets 18, bonds were positive. Lots of good numbers there, which I think proves an important point, because if you think back, I mean, even right now, the information flow around COVID and some of that stuff is not fantastic. And if you think back to last quarter in April and May, the news was probably even worse, right? Record unemployment, record job losses, the economy was falling, corporations shut down, which reinforces the important point that what matters in markets is not so much good or bad, but better or worse. And so markets aren't reacting to, hey, the news is good or the news is bad. It's what were expectations and then what is reality. And if you think about it, the expectations for some of the financial markets and what might happen to the economy were so poor that it was a pretty low bar for companies and the economy to jump over, and hence you see the strong performance here. Taking a longer term look, you see mostly green with a little bit of red, and the green there, US stocks looking back over a year up about 6.5%. International stocks down, bonds up, global real estate down as well. Some numbers there that are interesting. A couple things going on there with some of the international stocks. One was just the fact that for most of that period, the dollar was pretty strong. And so the dollar, when it is strong, takes away from international stock returns. And when it's weak, it adds to international stock returns. And we'll talk a little bit more about currencies here in a bit. The other thing is that some of those international markets went into the crisis with coronavirus a little bit earlier. If you remember, back in the winter, it was Italy and countries like that were really the focus of coronavirus, where those economies were shutting down, and there were lots of gruesome images coming out of places in Italy. And then those countries really have started to recover and performance has picked up, but still on a year-over-year basis, down a little bit. You can see longer term there in the middle, 5 years and 10 years. All green arrows, but U.S. stocks have certainly been the outperformers over the last decade, in the last 5 years. We'll talk a little bit more about that. We continue to be firm believers in international diversification, and for a number of reasons, some of which I'll cover a bit later. One other factor here to keep in mind with everything that you're looking at is the dominance lately of tech companies, right? So particularly the big tech companies, Facebook, Google, Microsoft, Apple, Netflix, Amazon, these 5 or 6 companies have really driven the vast bulk of stock market performance lately. One of the reasons you see while the S&P is essentially flat on the year, the NASDAQ is up 20%. It's just because of those large technology names. Why am I bringing that up? Well, for a couple reasons. First of all, if you look in your portfolios, the biggest stock positions we hold in our portfolios are those aforementioned tech stocks, the Facebooks, Apples, Amazons, and the like, Netflix. We just hold relatively less than the indexes. And so in the S&P 500 right now, 5 stocks make up about 21% of the index. In our portfolios, it's probably more like 5%. So still large weightings to those big tech companies, but we just think it's prudent to diversify a little bit more and have less, because what can go up can also go down. And we want to make sure that portfolios are properly diversified. We've seen the record too many times play around stocks that seem invincible and go up and up and up and then suddenly reverse course. But referring back to the international markets, one of the reasons that they've underperformed here in the last several years is, relatively speaking, technology makes up a larger proportion of the US stock market than international stock markets. The best sector has been technology. And so in an environment when technology does the best, that's disproportionately helped the United States, where it's a larger weighting, and disproportionately hurt international stocks where it's a lower weighting. And again, we like technology, we own it. It's very large weightings, but a little bit less than in some of those major indexes. Looking at world stock market performance last quarter, looking at a market that moved higher, like the number said, but look at some of these headlines, right? At least a fourth of US economy goes for idle from lockdown. China GDP falls 6.8%, first drop on record. Consumer prices post biggest drop since last recession during April lockdowns. Look at some of those headlines, right? Eurozone economy sees largest contraction on record. And then what came after that? S&P 500 up nearly 40% in past 50 trading days, followed by UK economy shrank a record 20% in April. So the stock market really is a leading indicator and started to recover despite the fact that the news flow hadn't improved yet. And never forget that stocks climb a wall of worry. And usually when pessimism is most pronounced is when stocks do the best. A little bit longer term, this is a 1-year chart. You can see the really sharp drop off there and then the recovery. And again, a number of headlines. But look at coming into the year, what you don't see if you look on the left-hand side of this chart is any mention of COVID. You see talk about the Fed cutting interest rates. You can see talk about the ECB cutting interest rates, manufacturing slowing down, China slowing down. US stocks closed out the decade with a pretty significant gain. And then look at this one headline: new virus discovered by Chinese scientists investigating pneumonia outbreak. Who would have thought that that one headline could have started all that we've seen since then? Certainly has been an interesting year. And again, just the difficulty of predicting these kind of things coming into the year. I think most of us were probably focused on an economic slowdown globally, trade wars with China and the US, potentially a weakening economy in the United States, maybe what the Fed was going to do. And certainly the election, which I'll touch on, was at the front of a lot of people's radars. Coronavirus, almost a non-event. And even into February, I think most people, myself freely, I'll admit included, I actually went on another TV show and said that I thought that the coronavirus would be similar to SARS and the avian flu and things like that, and that markets were probably overreacting when they first started to fall. And mea culpa, I was about as wrong as you could be, and certainly did not foresee the depth of the impact that coronavirus has had on society and the economy. World asset classes last quarter, really strong. Best performer, emerging markets, small companies. And so best performer there, 27% in a single quarter. Followed by the Russell 2000. Those are small cap stocks in the US, up 25%. So small companies really leading the way. And then you can see getting down here into the S&P 500 up about 20%, and then all the way down through T-bills, which were essentially flat. That's cash, and that's what you would expect when interest rates are at zero. But everything positive. And if we shift to the United States, let's look at what happened in the second quarter. And just as a reminder, US stocks make up about 57% of the world stocks. So a little bit under 60% of the stocks in the world are in the United States. If we look, performance was strong across the board. The US did great. It did better than international markets. It did better than emerging markets. As you all know, we favor value stocks and we favor smaller companies and we favor more profitable companies. Profitability helped last quarter, right? Quality companies that we think can continue to sustain their operations despite an economic slowdown, that did help. Small companies did very well last quarter, outperforming large companies. Value underperformed. And so a little bit of a mixed bag there, where we saw some of what we're leaning towards in the way of small companies definitely helping performance, and then value hurting a little bit. And that's to be expected. Sometimes things do well, the factors, sometimes they don't do as well. Again, this is a longer term research-based decision to slightly overweight some of these sectors. Turning to international developed stocks, if we look here, developed stocks did fantastic, had a great quarter, but not as good as either emerging markets or the United States. And here you're looking at a little bit over 30% of the world stocks are in these international developed countries. These are places like Japan, Canada, the UK, Germany, those sorts of countries. You can see the different performance here on the right-hand side. Smaller international companies did the best. Again, small companies outperforming last quarter. And then value companies did the worst, again, underperforming growth. And so there was really a premium on smaller companies and more growth-oriented companies last quarter. I had mentioned earlier the impact that currencies can have. And if you look at the chart here, you can see what the performance last quarter was in local currency, which is blue, and then US currency, which is the orange or yellow there. And it's really that orange or yellow that you're focused on, is that those are the performance that you're actually going to see, because you own, the dollars need to be converted into, or the foreign currency needs to be converted into US dollars. And so that's really what you care about. And that's a function of international currencies and foreign currencies strengthening versus the US dollar, actually helping performance in international markets last quarter, which was a little bit of a change in prior quarters. Like I said, over the last couple of years, the dollar has been strong and has actually hurt returns a little bit. Shifting gear to emerging markets didn't as a whole do quite as well as the US, but they did better than international markets. Here you're talking about 12% of the world's stocks are in emerging markets. Again, here, smaller companies did better, and that's a consistent theme where as we hit the depths of the slowdown in the economy, started to recover a little bit, the smaller companies with more potential growth ahead of them did better than the larger companies. Again, value underperforming a little bit. One interesting thing to highlight here is that in the last, 5 or 10 years, many of these emerging markets have been among the worst performers, which is quite a change from the decade prior, where the story was the secular growth story of emerging markets. I mean, in some ways, until the financial crisis, that was arguably the dominant theme of the mid-2000s. Since then, the financial crisis really harmed emerging market countries, and the performance has continued not to be great. And it's always important to differentiate when we talk about emerging markets. It's not a homogenous group. You're talking about countries as diverse as Poland and China and India and South Africa and Brazil, none of which really have anything to do with each other. So we lump them together, but the reality is that these are companies at different stages of development and with different economic cycles going on in different stock market capacity and valuations. But as a whole, I do have to say that we're quite optimistic on them, or at least I'm personally quite optimistic. Lack of crystal ball as far as knowing what's going to happen next month or next quarter. But the growth story in emerging markets, as far as their population growth, their economic growth, the transition from more manufacturing type economy to a more service-based economy, as well as the development of the burgeoning middle class in a lot of these countries, I think continues to open up tremendous opportunities. So too does the fact that in a lot of these countries, they're no longer, it used to be that if you went to some of the emerging markets, the main brands and the main companies were just US or European companies that had outposts there. Now you're getting a lot of homegrown champions that are just as prominent as US or European companies. And I think that really bodes well for future growth. So, if I'm looking out 5 or 10 years, I'm very, very optimistic about emerging markets. Although, again, not done as well recently, but they're cheap relative to historical averages. And again, I think that the long-term story is pretty compelling. Select market performance on the left. These are developed markets, and on the right, they're emerging markets. And so you can see that Australia and New Zealand led the way there among developed markets, with returns of almost 32% for Australia and about 27% for New Zealand. A big part of that play is, and you can see there that Canada is in the top half dozen too at 23%, followed by the US. Canada, Australia, and New Zealand are often called commodity currencies or commodity countries. They're very large producers of natural resources, and a large part of their economy and many of their largest companies are dependent on natural resources. You really saw natural resources, oil, gas, copper, and the like, more or less get crushed into the financial crisis and through March, or into the Corona crisis through March, and then rebound pretty strongly last quarter. And so I think that likely played a pretty significant role in that performance. You can see that as good as the US did, it was what, number 6 or 7 there as far as performance last quarter, but every country was positive. And then same thing in emerging markets. Argentina was the best performer. One thing to keep in mind about news flow, and I'm going to pop back a couple slides here. If we look here at this headline from last Q2, Argentina defaults on its sovereign debt. All right, let me read that again. Argentina defaults on its sovereign debt. That's the equivalent of the United States defaulting on treasury bonds. And then if we flash forward a few pages, we see the #1 ranked market in the whole world, emerging or developed, was Argentina, up 36%, right? And so quite a divergence there between a country defaulting on their treasury bonds, but having the best performing stock market. And I think that that's we get the question sometimes around, hey, we know the news is going to be bad, or we know the economic cycle is going to be bad. Why wouldn't you just sell stocks? This is a really, really powerful black and white example of why not, is because a lot of times the top level headline and then the underlying stock market performance are in no way related, and in some cases bipolar opposites. So I think that's a pretty powerful example of why it's important to look underneath the headline to determine whether or not owning an asset class makes sense. Currencies, I mentioned that for the first time in a while here over the last year, and then certainly last quarter, you've seen some of the international currencies start to appreciate versus the dollar. You can see that almost everything, with the exception of the British pound and then a couple of emerging market currencies, improved versus the dollar. The dollar actually strengthened against the pound and a few of those emerging market currencies. And again, currencies tend to move in long cycles where you'll see the dollar appreciate, broadly speaking, for a period of time and then depreciate for a period of time. And I don't have a crystal ball on currencies. But what I will say is that if you look, one of the reasons the dollar has been strong over the last 5-6 years is that interest rates in the United States were high. As low as they were high relative to the rest of the world, particularly once the Fed started to raise interest rates a couple of years ago. Flash forward to the last several months, and the Fed has lowered interest rates down to 0. U.S. Treasury rates to 10-year Treasury is quite low. So the differential between the United States and most other developed countries isn't nearly as great as it used to be. And all else being equal, that would be a dollar negative, which would also mean the equivalent of being foreign currency positive. So we'll see what happens with currencies. But certainly if the dollar weakens a little bit or even just stabilizes, that's a positive for international stock holdings. Real estate last quarter did just fine. You know, it was up roughly 10% across the board. So it didn't do as well as most other kinds of stocks, and not terribly surprising when you're in an environment where much real estate currently can't be used, right? I mean, if it's an indoor mall, at least here in California, you can't go to it. Office buildings are mostly empty and the like. So certainly real estate hitting a bit of a rough patch on the commercial side. The flip side is that by all accounts, residential is doing quite well and demand is quite strong and prices are okay. So real estate's a bit of a mixed bag, but still holding in there. Commodities. So commodities, again, year to date down almost 19%. A very, very rough start to the year where you saw oil. And for those of you that remember, there was a phenomenon at one point where the oil futures were actually trading at negative prices, negative $30 a barrel or something like that, which was a technical issue having to do with delivery of the physical oil and having no place to store it. But nevertheless, oil did drop down into the single digits. Recovered quite a bit. Now it's up around $30. So it's tripled in price from its lows, but still off by half or so over the last year. But commodity prices were, broadly speaking, up in the quarter. The one commodity sometimes to focus on here is copper, up about 21% last quarter. Sometimes copper is called Dr. Copper. And the joke there is that it's very, very good indicator of economic activity because it's used in so much building. And so a lot of times as copper goes, so goes the economy. And so certainly the rising price there is a good indicator for economic growth. As a reminder, we don't own physical commodities in the pure portfolios. The prices and the movements of them are too volatile. And frankly, over time, a lot of them haven't necessarily even kept pace with inflation. So we get commodities or natural resources exposure through the stocks of producers or processors of these raw materials. So it's a proxy for getting exposure to commodities, but we just think that the ability of a company to generate profits is a little bit more powerful than owning the underlying currency, or excuse me, the underlying commodity. Fixed income wise, and there's a ton of information on this chart. I would bring your attention to where I'm circling right now, which is the yield curve. June 30th of 2019, so a year ago, is there in green. And then here in yellow is June 30th of 2020. So you can see the sharp drop in interest rates, sharpest at the short end, so in short-term interest rates, but across the board interest rates coming down quite a bit. Just to point out here on some of the bond yields, the 10-year Treasury right now, about 2/3 of 1%, so very, very low. Bonds have been positive over time. There was a rough patch there in March when essentially the bond market was stopping to function. Even Treasury prices started to fall, which is really unusual. And some of the corporate bond markets were dislocated as people really didn't know if the companies could pay their bills if they weren't able to open their stores. The Federal Reserve really stepped in and supported the bond market and stabilized it, and that's been good to see. And bonds have been able to resume their traditional role as a hedge in portfolios. Global fixed income, I won't spend a ton of time on, but similar story where interest rates are very low, more or less across the board. And in fact, in some countries, such as Germany, interest rates are actually negative all the way out to 20 years. Japan, they're negative in the short run. So interest rates very, very low across the board. In all likelihood, a story that will continue. It's difficult to see interest rates soaring here in the near term, given the moves of central banks as well as the state of the economy. I want to shift gears here just a little bit because we are coming up on the silly season, what I like to call the election season. And lots of people have strong ideas on who they want to see elected. I'm going to keep my political views out of this and simply point to the facts. And the fact is that if you put $10,000 to work back in 1961, so over the last 80 years, and you only invested when a Republican was president, you would have about $86,000. If you only invested when a Democrat was president, you would have about $376,000. But if you stayed invested, you would have about $3.25 million, which is a better number. Right? I don't need to be too good of a financial advisor to tell you that $3.25 million is better than $376,000, right? Interesting though, right? I mean, that points to the fact that if you're really worried about who's going to be in office and you're moving in and out based on your political views, you're probably going to leave a lot of money on the table. The other interesting thing there is, although Republicans are often viewed as being more business friendly than Democrats, the fact of the matter is that markets have done better for the most part under Democrats. There's a lot of timing issues in there. It's not solely because of who's in office. It has a lot to do with who takes office and what the market is like then and what it's like when they leave and that sort of thing. A lot of data going on here. What I want to focus on is this right-hand column, which some of you may have seen in the past. It's what we call a quilt chart and or a periodical table. And so it basically looks at different asset classes and then stack ranks them from best performer to worst each year. And the reason I point this out is this is only election year. So 1992, 96, 2000, and so on through 2016. What you hear a lot of times is, hey, this sector or that sector will do well under X president, right? So if, John Doe is elected president, whatever, pharmaceuticals will do well or energy companies will do well. And what this shows is that in a variety of different election years, there's no real pattern to what kind of company did the best. And sometimes real estate did the best, other times real estate did the worst, financials did the best, financials didn't do as well, energy. So although there'll be a lot of talk around how this president, whether it's Biden or Trump, their policies are good or bad for a particular sector, a lot of times there are more fundamental factors at play than who's in office, because in all likelihood, even if a president's implementing new regulations or restrictions or providing new opportunities for an industry, a lot of times it's at the margin and doesn't outweigh how the underlying business fundamentals actually are. The last slide I want to show on the election is the market since 1926 under a variety of presidents, and just really demonstrating, I think, visually the more or less consistent move up. I mean, certainly there have been some drops along the way, but markets have done really well over time, except under poor President Herbert Hoover, under which the stock market cratered. But under every other president, markets have mostly gone higher, and it's been the case under Republicans and Democrats, red and blue. So markets have generally done okay regardless of who's in office. Again, political views are great, but it's always really important to kind of differentiate what you think should happen or the way that you want things to be versus what is likely to occur. I'll also say, and I'm happy to take questions on this, but my personal opinion is that I think markets can live with Biden or Trump. There were other candidates, maybe like Bernie Sanders, that I think markets would have had a little bit more trouble digesting. But I think a Biden presidency, markets may have a preference for one over the other, but I think they can live with either. Finally, I just want to point out two things on international equities, because as I mentioned, they haven't done as well over the last few years. due in part to a stronger dollar and due in part to having a little bit less exposure to technology companies. But in this chart, anytime you see red, so anytime that it's underneath the x-axis, international companies are doing better. And anytime you see green, US companies are doing better. And the point is simply that there's no real consistent story. You see a long period where mostly international stock did better, followed by a period of US outperformance, followed by international, US, international, US. And so the idea is, again, it's the benefit of diversification, and why we focus on it is that in different environments, different sorts of stocks in different countries tend to do better. And then the final thing I'll finish up with is valuation. And we're big believers that valuation matters, and the price you pay for an investment is really a key determinant of what kind of return you're going to get over time. And on this chart, anything above the x-axis is trading more expensive than its historical average, and anything below the x-axis is trading less expensive. And what you can see here is the US, where the arrow is pointing, is more expensive than historical norms. It doesn't mean stocks can't go up, and it doesn't mean there aren't cheap stocks. Certain segments of the US stock market are less expensive than average. So small value companies are less expensive than average. Large growth companies are more expensive. So it just depends. But when you look here at all these international companies, they're almost all less expensive than their historical norms, and in some cases significantly so, which we think is another compelling reason to maintain an allocation to international securities right now. With that, I've spoken a lot, Andy, so I'm going to take a drink of water while you collect the questions and let me know what comes next.
All right, so we do have a few questions that have come in. Samuel says, how do you see the unprecedented debt being incurred by the federal government affecting the markets in the next few years?
So to answer the question explicitly, in the next few years, I don't see it affecting the markets, more or less at all. I think that in the short run, the markets are only capable of focusing on a few things. And right now it's coronavirus and then the election and the economic recovery. Deficits and large national debts tend to be something that markets don't care about until they do. And people have been worried about the deficit for years, honestly. I do think at some point it becomes an issue. I just don't think it's in the next couple years. But to take that question out a little further, historically, when a country has a large national debt, there's really only 4 ways to get away from it. One is you can default on the debt, so you can just not pay your bills, but I don't think that's really a choice or something that's going to happen. You can grow your way out, so stronger economic growth will lead to paying down the debt, and that would be nice. I don't know if it's going to happen. I think the two most likely are, one is you can inflate your way out, so you can have a little bit higher inflation, which then means that you're using less valuable dollars to pay back the debt. It's easier to pay back. I think that could very well come into play. Again, I don't think that's a factor in the next couple of years. If you look out longer term, I do think that you could see a little bit higher inflation, and I think, frankly, the Fed and the government would tolerate a little higher inflation. And then the final one is higher taxes. And I think that, before coronavirus, higher taxes were, well, they're written into law after 2025, but even absent that, I think the path was towards higher taxes anyway. And now I think, given the additional debt we've incurred, plus the political climate of the country, I think higher taxes, whether it's next year or beyond that, are a virtual certainty. And, that's frankly one of the reasons we spend so much time focusing on tax planning.
You already spoke about the election. Samuel had a follow-up question. Do you see the results of the upcoming election having significantly different effects on the market? And how is Pure planning to mitigate any negative effects of one outcome versus another?
Yeah, so it's a good question. If we go back to the chart, the historical average tells you, or the historical record tells you, that it doesn't really matter whether the Republican or the Democrat wins. Markets are going to do what they're going to do. So we don't necessarily want to make a knee-jerk reaction. Not least because, honestly, if you had told us, everybody, not everybody, but almost everybody thought Trump would lose the last election, but they also thought that if he won, the market would plummet. And not only did he win, but markets soared immediately afterwards. So it's pretty difficult to forecast these things. Again, I think the market can do okay with either Biden or Trump. I think all else being equal, they'd probably prefer Trump. But Bernie Sanders, I think markets were spooked about that. So, unless I don't think he's going to be vice president. If you got like a Elizabeth Warren named vice president or somebody like that, that's considered more of a populist, I think that could change things. But if it's another somewhat moderate Democrat that gets named vice president, I think my opinion is that markets can accept that. And what's really going to happen is that markets at that point aren't going to vote based on, hey, this is Biden or not Biden. They're going to say, where are we at with coronavirus right now? Where are we at with the vaccine? Where are we at with reopening the economy? And that's going to be number one. Number two is going to be, where are we at with the economic cycle and the recovery from the damage we've seen from shelter in place and coronavirus? That's going to be number two. And then number three will be something along the lines of, all right, well, what are some of Biden's specific policies? And by that, I mean, not necessarily campaign rhetoric, which a lot of times is a couple degrees of magnitude more extreme than what actually happens, but what is actually likely to occur in the way of potentially higher taxes, potentially additional regulation, et cetera. And markets will move off of those, not just, hey, Biden got elected.
Barbara has a question. How is the company positioned as far as cryptocurrency and a digital economy?
Yeah, I mean, so that's really kind of two questions, right? Because the digital economy is obviously here to stay. We're having this meeting over Zoom because we can't see people in person, right? So we're fully embracing the digital economy. We think it's the future. We're doing digital webinars, meeting with clients digitally. Like I said, we own technology stocks in portfolios in order to benefit from technology over time. But, you know, as far as cryptocurrencies, we don't own cryptocurrencies. My opinion is that, and we have a video on this on the website too, if anybody wants to. I did a video a couple years back. You know, cryptocurrencies to me are not an investment. The definition of an investment is something that produces cash flow in the future, and you can discount those cash flows back to net present value. Cryptocurrencies don't have cash flow, so they can't be an investment. The same thing would go for gold. Additionally, the IRS has not necessarily, they've kind of said that they're not legal currency either. So it's a little bit of a nebulous spot. I mean, it doesn't mean they can't go up in value. It just means that we don't own them. They could do just fine. They could go much higher. I don't know. But we don't have the ability to value them the way that we would a stock or a bond or a real estate or something that produces cash flow. So we've tended to avoid them. The last thing I'll say on that is if you do buy cryptocurrencies, just keep in mind that Bitcoin's a dominant player, but that doesn't mean ultimately it'll be the winner. There have been something on the order of 5,000 car makers in the United States since the 19th century, right? And if you look at it, like 2 of them haven't gone bankrupt, and today there's 4 or 5 domestic car makers. So just because an industry, you're in there at the inception and you identify that, hey, this is going to be a growth industry, doesn't necessarily mean that the early leaders are going to be the winners in that space. I would reference MySpace. If anybody uses social media, you probably don't use MySpace anymore, but it had a pretty good head start ahead of Facebook and Instagram and those.
All right. As a reminder, if you have any questions, type them into the Q&A and we will get to them. Right now, we have one left. It's from Marty. He says, growth has outperformed value over the past 12 plus years and also during the COVID recovery during Q2. This has obviously impacted the return of our portfolios. Is it finally time for value to outperform as the COVID recovery continues to take place?
God, I hope so. Yeah. I mean, and so, you know, it was a little bit of a unique, it's always unique, but it was a little bit of a different decline and rebound in that usually what does best going into something does not do the best coming out. But technology was doing really well leading into this. And then due to the nature of what prompted the market sell-off and recession, being that we're all stuck at home, technology did well coming out because it was the only thing people could use. But I will say that was really only the case until about the end of April. Since then, value's actually begun to perk up a little bit. Performance has been a little bit more mixed. And so when you look at some of the longer term numbers, they're really skewed by the fact that value was slightly incrementally underperforming growth for, 5, 7, 8, 9 years. But it wasn't doing horrible. It was just kind of lagging just a little bit. And then if you look in basically the last 2 to 3 years was when technology stocks really started to take off and then lately. So a lot of those longer term numbers are skewed a little bit by recent performance. But certainly we hope and we expect value to turn around. That's why we own it. We still think that both on a academic basis, as far as the research, on a logical basis, value makes sense. And additionally, if you just look at valuation, so not value, but valuations, relatively speaking, compared to their historical norms, value stocks are very cheap. Growth stocks are quite expensive, and we would expect that differential to close over time. So, if anything, this would be the time that we're more convicted about value stocks as opposed to less. Wish I could say exactly when the tide will turn, but we have a high level of conviction that it will turn and that we'll be in for a sustained period of really strong performance.
All right. So if you have any further questions, you can email Brian directly at info@purefinancial.com so that he can answer those for you. Brian, thank you very much for the market update webinar.
Cool. Well, thank you all. And everybody, again, stay healthy, stay safe. If you have any questions, just let us know. We're always happy to chat. And best of luck going forward. Take care.